our knowledge series on corporate tax in UAE. In this video you will learn about the transfer pricing. This video covers the following important matters of transfer pricing: arm's length principle, comparability factors, transfer pricing methods, examination and adjustments to transfer price by FTA, transfer pricing documentation and requirements relating to local file and master file. Introduction. Transfer pricing applies to transactions between related parties since there is the potential to set a transfer price that changes how profits are split between them, which is sometimes referred to as tax arbitrage. For example, more profits are taxed in a low-tax jurisdiction. Transfer pricing rules ensure that transfer prices are set such that a taxable person is charged tax on their fair share of the profit. OECD guidelines. These guidelines on transfer pricing were provided to help establish a fair way to deal with transfer pricing for tax. These guidelines are used in numerous instances in drafting international tax agreements. Some countries have their own domestic transfer pricing rules based on the OECD guidelines. Arm's length principle. Arm's length approach treats the entities involved in related parties' transactions as if they were unrelated. Arm's length price is the price that would be paid in a comparable transaction between unrelated parties. Comparability of transactions. There are two main aspects to analyzing comparability of a transaction. First step is to identify the commercial or financial relations between the associated enterprises and the conditions and economically relevant circumstances attaching to those relations. Second step is to perform a comparability analysis between the related parties or controlled transaction and those of comparable transactions of independent enterprises in order to determine an arm's length price. There are 5 methods to determine a suitable transfer price, which are discussed in this video. Arm's length requirement. In determining taxable income, transactions and arrangements between related parties must meet the arm's length standard as specified in Article 34 of Corporate Tax Law, and any conditions that may be prescribed in a decision issued by the FTA. According to Article 34 Clause 2 of the Corporate Tax Law, a transaction or arrangement between related parties meets the arm's length standard if the results of the transaction or arrangement are the same as they would have been if they had taken place between persons who were not related parties. To meet this condition, the transaction or arrangement between the unrelated parties would need to be similar to, and have been carried out under similar circumstances to the transaction or arrangement between the related parties. Arm's length methods. Under Article 34 Clause 3 of the Corporate Tax Law, preferred transfer pricing methods are listed below, which can be used as one or in combination to determine the arm's length price. Comparable uncontrolled price method, resale price method, cost plus method, transactional net margin method, transactional profit split method. As per Article 34 Clause 4 of the Corporate Tax Law, any other transfer pricing method may be chosen, where the taxpayer can demonstrate that none of the 5 given methods can be reasonably applied to determine an arm's length result and that the alternative method chosen does give an arm's length price. Comparability factors. Under Article 34 Clause 5 of the Corporate Tax Law, when choosing and applying a transfer pricing method, the taxpayer must have regard to the most reliable method, and the following 5 comparability factors must be taken into account, which are broadly equivalent to the comparability factors that are used when determining an arm's length price according to the OECD's transfer pricing guidelines. Contractual terms of the transaction or arrangement, characteristics of the transaction or arrangement, economic circumstances in which the transaction or arrangement is conducted, functions performed, assets employed, and risks assumed by the related parties entering into the transaction or arrangement, and business strategies employed by the related parties entering into the transaction or arrangement. As part of the comparability analysis process, the most appropriate method to determine the transfer price is selected. These methods compare the controlled transaction with an uncontrolled transaction. Transfer pricing methods. The 5 methods can be divided into traditional transaction methods and transactional profit methods. Traditional transaction methods. Comparable Uncontrolled Price Method, CUP. CUP seeks to compare the related party transaction or arrangement to a comparable uncontrolled transaction. Product similarity is very important to the CUP, however, all 5 of the key comparability factors listed above need to be considered. CUP can be subdivided into following 2 types. Internal CUP, which is usable when an enterprise sells the same product or service to a third party as it does to an associated enterprise. External CUP, which is usable for a transaction between 2 unconnected parties. Generally, an internal CUP will give rise to more reliable data. This method is useful in a manufacturing context where many identical physical products are made. Resale Price Method, RPM. This works backwards from the retail price to find the transfer price using the gross profit margin that should be earned by the selling company, by analyzing a similar product to examine what margin is earned by a similar sales competitor. The arm's length transfer price is the retail price less the gross profit margin, less any other costs associated with the purchase of the product, for example customs duties. RPM is most often used for distribution and marketing operations, where the distributor does not contribute substantially to the creation or maintenance of intangible property, such as a local marketing intangible. This is because the contribution of the goods originally transferred to the value of the final product is difficult to ascertain. Gross profit margin is calculated as gross profit divided by revenue. Cost plus method, CPM. First step when using the cost-plus method is to determine the cost incurred by the supplier. Then an arm's length markup is added to that cost base. The markup is applied to the direct and indirect costs of production. This method will be useful where semi-finished goods are sold between entities of a M&E, where associated parties have joint facility agreements or long-term buy and supply arrangements, or where the controlled transaction is the provision of services. Transactional Profit Methods. Transactional Net Margin Method, TNMM, Contribution Analysis Profit Split. TNMM is generally based on the operating margin, that is gross profit after the deduction of selling and other operating expenses, but before deduction of interest, extraordinary items and income taxes. However, the OECD transfer pricing guidelines refer to net profit, hence we have mentioned same. TNMM examines the net profit from controlled transactions as a percentage of a base profit level indicator, such as sales, costs, assets, etc., and compares it with a similar uncontrolled net return. Ideally, the uncontrolled net return should be established by reference to returns earned by the same taxpayer in comparable uncontrolled transactions with unrelated parties. TNMM implies that companies in the same industry will tend towards the same net profit levels over time. If one company had higher returns than the rest, then it would be able to expand at the expense of the others, and eventually the less efficient companies would go out of business. Transactional Profit Split Method, Residual Analysis Profit Split. This is the only two-sided approach and is not reliant on comparable. It seeks to split the profit, based on the split that would occur between independent entities in comparable transactions. High integration level within a M&E may make the transactional profit split method a preferable approach. Integration means that the way in which one party to the transaction performs functions, uses assets, and assumes risks is interlinked with the other party. This makes it hard to evaluate the transactions in isolation from the way in which each party to the transaction performs functions, uses assets, and assumes risks. Transactional profit split method takes the combined profit that is earned in the controlled transaction and divides it between the related parties of the controlled transaction on an economically viable basis. This can either be done via contribution analysis or residual profit split, as mentioned below. Contribution analysis allocates the profit or loss to each company in order to provide a market return, based on the returns of independent entities, for the transactions in which it is engaged. Residual profit split is a two-step approach and is particularly useful where both parties own valuable intangibles. Firstly, a return for the usual operations is allocated, then the residual profits are split amongst the difficult-to-price functions such as intangibles. Illustration: Residual profit split. Company A develops a valuable intangible which it licenses to its 100% owned subsidiary, Company B. Company B uses the IP from the parent alongside its own IP, which has been developed to adapt the product for the local market. Company B markets the adapted product in Europe under its own brand name. In a tax year, Company A has no direct costs related to the license. The tax authorities for Company A determine that a residual profit split is the most appropriate transfer pricing method. It is also determined that the first step of the profit split will be undertaken based on a return to assets employed. Assuming the assets employed by Company B are $250,000 and that the appropriate return is 15%, which gives a return of $37,500 to Company B. Assuming that the pre-royalty profits for Company B are $200,000. After we deduct the $37,500 of profits for Company B for its contribution, this leaves $162,500 of residual profit left to be split. It is determined that the residual profit will be split based on capitalized expenditure on intangibles as shown in the balance sheet of each company. Assuming that Company A has $3.75 million in its balance sheet and Company B has $1.25 million in its balance sheet. This means that the residual profit of $162,500 will be split as 3.75 divided by 5 to Company A, being $121,875, and 1.25 divided by 5 to Company B, being $40,625. Examination of transfer price. According to Article 34 Clause 6 of the Corporate Tax Law, FTA can examine whether income and expenditure resulting from relevant transactions or arrangements meet the arm's length standard, by determining the appropriateness of transfer pricing method having regard to the comparability factors given in the Article 34 Clause 5 of the Corporate Tax Law. Article 34 Clause 7 of the Corporate Tax Law mentions the application of selected transfer pricing method or a combination of transfer pricing methods may result in an arm's length range of acceptable figures, subject to any conditions specified in the FTA decision. As per Article 34 Clause 8 and 9 of the Corporate Tax Law, where the result of the transaction or arrangement between related parties does not fall within the arm's length range, the FTA shall adjust the taxable income to achieve the arm's length result that best reflects the facts and circumstances of the transaction or arrangement. Any adjustment made will rely on the available information. Adjustments to transfer price. According to Article 34 Clause 10 and 11 of the Corporate Tax Law, where the FTA made any adjustment to the income of a taxable person in order to meet the arm's length standard, the FTA shall make a corresponding adjustment in respect of any UAE resident related party. Where a foreign competent authority makes an adjustment to a transaction or arrangement involving a UAE resident to meet the arm's length standard, the taxable person can make an application to the FTA to make a corresponding adjustment to its taxable income. Transfer pricing documentation. Requirements for companies of any size. Article 55 Clause 1 of the Corporate Tax Law states, the FTA may, by notice or through its decision, require a taxable person to file together with their tax return, a disclosure containing information regarding the taxable person's transactions and arrangements with its related parties and connected persons in the form prescribed by the FTA. Requirements for companies above de minimis threshold. Under Article 55 Clause 2 of the Corporate Tax Law and Article 2 Clause 1 of Ministerial Decision No. 97 of 2023, on requirements for maintaining transfer pricing documentation, a taxable person will maintain records including a master file and a local file, if it is a constituent company of a multinational enterprise M&E which has total consolidated group revenue of at least AED 3.15 billion in the tax period, or it has revenue in the tax period of at least AED 200 million. Under Article 2 Clause 2 of Ministerial Decision No. 97 of 2023, the local file must contain details of transactions or arrangements with the following related parties and connected persons: non-resident person, exempt person, resident person who has made a valid election for small business relief, and resident person whose income is subject to a different corporate tax rate from that applicable to the income of the taxable person. Under Article 2 Clause 3 of Ministerial Decision No. 97 of 2023, The local file does not need to contain details of transactions or arrangements with any other resident-related parties and connected persons other than those listed under previous clause. Nor does it need to include transactions or arrangements with individuals, provided that the parties to the transaction or arrangement are acting as if they were independent of each other. Juridical person that is considered to be a related party or a connected person solely by virtue of being a partner in an unincorporated partnership, provided that the parties to the transaction or arrangement are acting as if they were independent of each other. And permanent establishment of a non-resident person in UAE, whose income is subject to the same corporate tax rate as that applicable to the income of the taxable person. Under Article 2 Clause 4 of Ministerial Decision No. 97 of 2023, parties are considered to be acting as they were independent of each other if relevant transaction or arrangement is undertaken in the ordinary course of business, and parties are not exclusively or almost exclusively transacting with each other. As per Article 2 Clause 5 of Ministerial Decision No. 97 of 2023, persons cannot be independent if they are subject to detailed instruction or comprehensive control from another person who is a party to the same transaction or arrangement. Article 55 Clause 3 and 4 of the Corporate Tax Law states, the master and local files should be submitted to the FTA within 30 days from the date they were requested, or any later date as FTA prescribed. Upon request by FTA, the taxable person shall provide information, within 30 days of request or later date as FTA prescribed, to support the arm's length nature of the transactions or arrangements with its related parties and connected persons. This ends our video session. Subscribe to our channel, and click on notification icon to stay tuned to the series of valuable material that will cover all aspects of the UAE corporate tax. Our partner is available for free consultation who is holder of FTA-approved UAE corporate tax qualification. His contact details are provided here. Visit finexcel.ae. Navigate to our clients and testimonials webpage to see more clients' review on our services and our major clientele. Contact us for more detail. FinExcel. We create value that matters.